You have just 6 weeks left to lock in an instant guaranteed return of 11.5% to 22%. But here's the brutal truth. If you leave that money in cash, you are actively choosing to destroy your own wealth. The clock is ticking. December 31st, 2025 is the final deadline to contribute to your supplementary retirement scheme, or SRS, and qualify for tax relief for this year of assessment. Miss this date and you lose the single best risk-free return available in Singapore today. But if you're an investor who just tops up, you're only seeing half the headline. The real story, the one the wealth managers won't tell you, is not about the tax savings. It's about the cash trap that follows. Nearly 19% of all SRS funds sit in cash, earning a pathetic 0.05%, while inflation eats away at 2.5% per year. This is a far more complex story than it appears. You're being told you're safe when in reality, you are voluntarily lighting your purchasing power on fire. You save 11.5% on taxes only to voluntarily lose 39% of your purchasing power over the next 2 decades. This is financial negligence, and today we are going to fix it. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive slide by slide through the SRS cash trap and provide a clear 3 ETF solution to automate your retirement wealth. First, let's get on the same page. Let's look at the core concept, the instant return math. Most people call this tax savings. This is the wrong frame. This is an instant guaranteed profit. When you contribute to your SRS, you reduce your taxable income dollar for dollar. Your personal tax bracket is your instant return percentage. Let's break this down. If your chargeable income is $120,000, you fall into the 11.5% tax bracket. When you contribute the full $15,300, you immediately save $1,759.50 in taxes that you would have otherwise paid to IRAS. That is a guaranteed 11.5% return on your capital before you even invest a single dollar. The higher your income, the better this deal gets. At $200,000 income, it's an 18% instant return. At $400,000, it jumps to 22%. For us as Singapore investors, this is a no-brainer. Where else can you find a guaranteed risk-free 11.5% or 22% return? Stocks, REITs, bonds, none of them offer a guaranteed return. This is the government literally paying you to save for your own retirement. But this gain is only real if you keep it. And this brings us to our second point, the real headwind, the cash trap. This is what I call the top up and forget mentality. This is where most people destroy their SRS wealth. They top up, get the tax saving, and then leave that money sitting in cash, earning 0.05% per year. They think they are being safe. They are not. They are guaranteeing a loss. According to Ministry of Finance data, nearly 19% of all SRS funds sit idle in cash. Why is this a disaster? 2 words, inflation and lock-in. Your SRS money is locked up until you are 63. Let's run a simple calculation. If you are 40 years old today, you have 23 years until you can touch this money. If inflation runs at a very conservative 2.5% per year, that $15,300 in cash will lose 39% of its purchasing power by the time you can withdraw it. You've been played, you secured an 11.5% gain only to lock in a 39% loss. This is the safety illusion. You are lighting your money on fire. The entire purpose of the SRS system is to provide a tax advantage environment for growth. If you are not investing it, you are wasting the single biggest advantage the platform gives you. So how do we fix this? This is our third slide, the safe growth solution. Most people leave their SRS in cash because they are paralyzed by choice. They don't know what to buy, so they buy nothing. This is where we as analytical investors apply a simple, boring, and automated safe growth strategy. We are not trying to pick the next Tesla or Nvidia. We are trying to build compounding long-term retirement wealth while we sleep. We do this by buying just 3 exchange-traded funds, or ETFs, that cover Singapore blue chips, REITs, and investment-grade bonds. Let's break down each one. ETF number 1 is for stability. This is our anchor. For this, we use the ABF Singapore Bond Index Fund with the ticker A35. This is probably the most boring and safest ETF you can own on the SGX. It tracks the iBoxx ABF Singapore Bond Index, which means it holds AA-rated Singapore government and government-linked bonds. What is its role in our portfolio? This is our ballast. When equity markets panic and sell off, high-quality bonds tend to hold steady or even rise as investors flee to safety. It has delivered a 3-year annualized return of around 7.47% as of November 2025, with a low expense ratio of 0.32%. For our SRS portfolio, this is the foundation. We are not trying to get rich with this part of the portfolio. We are trying to stay rich and protect our capital. Next, ETF number 2, income. This is our income engine. For this, we use the Phillips S-REIT ETF, ticker CLR. This ETF tracks a basket of high-quality Singapore REITs, which are screened for their financial health and, most importantly, their dividends. Its role is to generate steady passive income. It currently has a dividend yield in the range of 5.27% to 5.59%. This is crucial. Inside your SRS account, these dividends are received tax-free and can be reinvested, allowing your wealth to compound much faster. The ETF is well diversified and capped at 10% per constituent, which reduces our single REIT risk. This is the workhorse of the portfolio. While we wait for retirement, this S-REIT ETF is constantly generating cash flow, which then buys more units, which generates even more cash flow. This is the magic of compounding, and it's happening in a tax-sheltered environment. Finally, ETF number 3, growth. This is our growth driver, our exposure to the broader Singapore economy. For this, we use the classic SPDR STI ETF, ticker ES3. This, as you know, tracks the 30 largest blue chip companies on the Straits Times Index, our banks like DBS, OCBC, and UOB, plus giants like Singtel. This ETF's role is long-term capital appreciation. We want to profit as Singapore's largest companies grow and benefit from regional trends. It's had strong YTD performance and a 5-year annualized return of 16.31%. This will be the most volatile part of our 3 ETF portfolio, but it also provides the highest potential for long-term growth. This is how we beat inflation and then some. The combination of A35 for stability, CLR for income, and ES3 for growth gives us a balanced, diversified, and automated portfolio. Now, let's put it all together. Why is this strategy so powerful? Why is buying these 3 ETFs inside SRS so much better than just buying them in a regular brokerage account? The answer is capital efficiency. In your regular account, say your Mumu or Tiger account, you invest with post-tax money. You earn $120,000, you pay your taxes, and you invest what's left. With SRS, you invest with pre-tax money. If you're in that 11.5% tax bracket, every $1 you put into your SRS is like investing 1.150. You are starting with a larger capital base from day one. Compounding returns on that larger base for 20 or 30 years creates a wealth gap that your regular brokerage account simply cannot catch up to. And the benefits don't stop there. When you finally withdraw the money after age 63, only 50% of the withdrawal is taxable. If you plan this correctly, for example, by withdrawing $40,000 per year for 10 years, the first $20,000 of that is considered taxable. But in Singapore, the first $20,000 of income is tax-free. This means you can potentially withdraw your entire massive compounded pot up to $400,000 over 10 years and pay 0 tax on the way out. You get a tax break on the way in, tax-free growth, and a tax-free withdrawal. It is the single best deal in town. But before you log in and transfer the money, we must be strategic. This is not a blind recommendation. There are 3 critical considerations, our guardrails, that you must check. First, check the $80,000 total relief cap. Singapore caps all your personal income tax reliefs, CPF top-ups, working mother's child relief, etc. at $80,000 per year. If you already hit this 80K cap, then topping up your SRS gives you 0 additional tax benefit. You must calculate this first. Second, do not lock up your emergency cash. This is crucial. Any early withdrawal from SRS incurs a 5% penalty, and 100% of the sum is taxed. Only contribute money you are certain you will not need before you turn 63. Third, plan for the 10-year withdrawal window. You have 10 years starting from your first penalty-free withdrawal to deplete the account under the tax concession. Plan your pot size so you can pull it out efficiently over that decade. This is about being smart, not just fast. All right, let's summarize today's deep dive. What's working for this strategy? First, the instant guaranteed return from tax relief, from 11.5% to 22%. Second, the power of capital efficiency by investing pre-tax dollars. Third, the tax-sheltered compounding, where all your dividends and gains grow tax-free. And fourth, the tax-free withdrawal, if you plan your 10-year window correctly. What's not working, or what's the key risk? The main headwind is human inertia. The single biggest risk is that you do nothing. You'll skim this, think, yeah, I should do that, and then miss the December 31st deadline. The second risk is that you do top up, but you leave the money in cash at 0.05% and let inflation destroy your savings. This is a long-term strategy, and you must treat it as such. The valuation here isn't on a stock, it's on a strategy. And the valuation is incredibly attractive. You are getting an 11.5% discount on your investment from day one. That's a margin of safety you will never find in the open market. So here is my final recommendation. This is split into two parts. For existing unit holders, that is for those of you who already have an SRS account with money sitting in cash, your mission is urgent. You have already secured the tax relief, but you are now losing to inflation every single day. You must get that cash deployed. Log into your broker, buy these 3 ETFs, and put your money to work. For new buyers or those considering topping up, you have 6 weeks. The risk reward is crystal clear. The deadline is December 31st. My recommendation is to execute. Don't wait until the last day banks get swamped. Step 1, open your SRS account. Step 2, transfer the contribution up to $15,300 by December 26th to be safe. Step 3, do not leave it in cash. Buy the 3 ETF portfolio. 20 years from now, you will thank yourself. If you found this analysis valuable and want to go deeper into the execution, like the exact percentage allocations for these ETFs based on your age, and a step-by-step guide on how to link your SRS account to a broker to actually buy them, that's all in my premium Substack newsletter. If you found this valuable and you want to cut through the noise in your portfolio, consider becoming a free or paid subscriber to the Investing Iguana on Substack. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, and I'll see you in the next analysis.